crisis in Japan is threatening the global stock market. It's called the yen carry trade, and right now it has started to unravel, and it also impacts India.
Massive global unwinding.
The unwinding.
In August 2024, we got a preview. The Japanese stock market crashed 12% in a single day, its biggest one-day fall since 1987. Global markets also tanked, and India wasn't spared. That day, the Nifty fell by 2.7% intraday. Today, I'm going to break down what exactly is happening right now, what has changed since, what this trade is, and why it's collapsing, and how India gets affected by it, and most importantly, what this means for your portfolio. Hello everyone, I'm Uday Nadde, and I've been licensed in Indian financial services since 2015, and so far I've helped over 2,000 families make better financial decisions. And here on my YouTube channel, I talk about all things money and personal development. Let me explain the yen carry trade with a very simple example so you understand why this is dangerous. Imagine a big fund, let's say a hedge fund, puts down $10 million of its own money, and then it borrows $100 million worth of Japanese yen at just 0.5% interest. And that was the beauty of Japan. Borrowing was almost free. Now that same fund invests the 100 million in US corporate bonds yielding 5%, or even US treasuries yielding slightly lower than that. The cost for this entire investment that they have done is 0.5% interest on their yen loan. That is just $500,000 per year. Now, the income that they earn on this, the 5% bond, is $5 million per year. Their net profit is $4.5 million, and a return on their original investment amount of $10 million is staggering. 45%, right? $4.5 million divided by $10 million. Obviously, there are some costs here in terms of hedging currency, but let's keep that aside for now for the sake of this example. And this was why everyone was borrowing low interest money from Japan and using it to invest across the world. The returns were insane. But here's the catch. If the Japanese yen strengthens by just 5%, that 100 million loan now costs $105 million to repay in terms of dollars. Half the fund's equity is wiped out instantly. Margin calls get triggered, and people have to start selling the investments they have made just because they have to now pay back this loan. And the only way they can pay that back is by selling what they have invested in so that the funds become available. This is exactly what happened in August 2024 when the stock markets around the world felt jitters. And now the conditions for an even bigger unwind are falling into place. Here's what makes the current situation extremely dangerous. In 2024, Japanese yields rose because the Bank of Japan raised interest rates. The yen strengthened. That was a good rise in terms of yield. It showed confidence in the economy. In November 2025, yields are rising for a completely different reason. They're rising because investors are worried about Japan's ability to manage its debt. And now the government is adding another 18 trillion yen in fresh borrowing. Here's the terrifying part about this. Yields are rising, but the yen is weakening. It's hovering around 156 to the dollar. This is what is called a bad rise in yields. It's not about economic strength, it's about fear. Then just last week, Japan's Prime Minister announced a massive stimulus package worth around 21 trillion yen. That is roughly $135 billion US dollars. This is in the form of tax cuts, cash handouts, and energy subsidies. To fund this, Japan needs to issue around 17 to 18 trillion yen in new government bonds. But here's the problem. Japan already has the highest debt to GDP ratio in the developed world of around 250 to 260%, depending on how you measure it. And now they need to borrow more. Investors are nervous about this. They are demanding higher interest rates to lend money to Japan. As a result, Japanese government bond yields have spiked to levels we have not seen since 2008. The 10-year yield has now crossed 1.8%, the 30-year yield has touched 3.3 to 3.4%, and the 40-year yield is near an all-time high of 3.7%. Let me show you the 20-year Japan bond yield, right? Look at that. It's 2.8% at a level it has never been since 2007, because this is the extent at which TradingView shows the data. So now, what's particularly alarming is the curve steepening. You see how it has quickly spiked up? The 2-year yield is still under 1% because the Bank of Japan's policy rate is at 0.5%. But long-term yields at the same time, as you saw, are exploding. This suggests that markets are pricing in what economists call fiscal dominance, where government borrowing becomes so large that it effectively dictates all monetary policy, regardless of what the central bank actually wants. Here's something even more truly remarkable. Chinese 10-year government bond yields have actually fallen below Japanese yields for the first time since records began in 2000. Just think about it. Japan, the poster child of deflation, of low interest rates for 3 decades, now has higher long-term rates than China. Japan is reflating while China is Japanifying, if I may say that. Now you might think, what's the big deal with all of this, right? 3.4% yields. In India, we're used to 6.5%, 7% bond yields. But for Japan, this changes everything. When a Japanese pension fund or a life insurer can earn 3.4, 3.5 to 4% risk-free interest in yen at home, why would they take the currency risk and invest abroad? Here's the math. Hedging Indian rupees or US dollars back to Japanese yen costs roughly 1.5 to 2% per year. So if you're a Japanese investor earning about 6.5, 7% in India, after hedging, you're maybe left with about 4.5 to 5%. Compare that to the 3.5% completely risk-free at home, and suddenly overseas investments look much less attractive. A further increase in the bond yield in Japan, as you can see, right, that there's still a difference between what you can earn in Japan and what you can earn elsewhere in the world, including all costs. But the moment these yields increase, that can cause capital to flow back to Japan. And when capital flows back, traders need to buy yen to repay their loans, so the yen strengthens. And that triggers margin calls on all those leveraged carry trades that I told you about earlier. I just earlier gave you an example of what happens when the yen appreciates by 5%. Just see how that starts to unwind when the yen starts to appreciate at a much higher quantum. And when that happens, whoever has invested using borrowed money from Japan has to sell, and that can in turn trigger sharp drops in the stock market. If you want to apply what I share here on YouTube to your own life and investing, check out my program, The Complete Guide to Mutual Fund Investing. It has all my years of experience of being licensed in Indian financial services since 2015. In it, I've covered topics like how you can select mutual funds to invest in, how to build your mutual fund portfolio, a much deeper dive than this particular video, what is an SWP and how to plan for your various goals, among other topics as well. The guide also has Excel tools like this one, where you just enter the goal that you have, the money that you require for it, and it automatically tells you, factoring in inflation, how much you need to invest per month from now onwards and which mutual funds to go for to save for that goal. Once you sign up for the guide, you'll also be part of our monthly live Q&A sessions where I answer all your doubts. To check out the program, go to the first link in the description and the pinned comment. Now, before we talk about its impact on India specifically, let's understand the scale of this global phenomenon. The honest answer is nobody really knows. No regulator has consolidated numbers, but we can piece together order of magnitude estimates from the Bank for International Settlements and CFTC data. Japan has net external assets exceeding $3 trillion, making it one of the world's largest creditor nations. BIS data shows cross-border yen lending has exceeded $1 trillion. Japan is also one of the 2 largest foreign holders of US treasuries with holdings around $1.1 trillion. Now the point is, this isn't some very niche specific trade. The yen carry trade has been a recurring amplifier in several major crises that have happened over the last 3 decades. Now let's talk about India very specifically, and this is where it gets slightly complicated, so let me walk you through what we can actually track versus what we have to estimate. The direct Japanese investment in Indian equities, that is registered FPIs from Japan, that we can see in NSDL data ranges from 1 to 2 lakh crores depending on the reporting period. This fluctuates with market movements and the flows that are happening on a day-to-day or a month-to-month basis. But here's the key insight. A lot of yen-funded money does not directly come from Japan into India. It comes through financial hubs like Singapore and Mauritius. According to SEBI data, the total FPI assets under custody were around 69.5 lakh crores as of March 2024. Singapore alone accounts for 9 to 10% of that, somewhere between 6 to 7 lakh crores. Mauritius accounts for 6% of that, around 4 to 4.5 lakh crores. Now remember, not all of this is yen-funded money, far from it, but Singapore is a major hub for Asian hedge funds and wealth management offices, many of which use cheap yen borrowing as a part of their funding mix. This is a common practice in global macro strategies. Now, when I put all of this together, direct Japanese FPI, an estimated portion of the Singapore and Mauritius flows into India that might be yen-funded, and even speculative ODI capital, my rough estimate is that around 50 to 60 billion US dollars in Indian assets could be meaningfully sensitive to what happens in Japan. I want to emphasize this very strongly. This is a back of the envelope estimate based on my assumptions. And it's not a precise figure that we have got from an official source. Now, this alone is not an existential threat to the Indian stock market. Our total market cap is around 470 to 475 lakh crores. This estimated exposure is roughly just 1% of that, but it has huge ramifications in other global markets, including the United States. So any increased volatility or a sharp crash in those markets because of the yen carry trade unfolding there will cause a significant increase in volatility even in India, and it would have second order impacts. Let me share 3 specific numbers that you need to be watching for this. These aren't official red lines, they're analytical thresholds based on how institutional money thinks. Trigger 1, a 2% yield on the 10-year Japanese bond, currently at about 1.8%. The moment it crosses 2%, that's a psychological and asset allocation threshold. At 2% domestic yield, the math for Japanese life insurers and pension funds changes dramatically. Hedged US treasuries, which might yield 4.5% but cost 1.5 to 2% to hedge, suddenly look barely better than staying at home at just 2%. Trigger number 2, the US dollar to yen is at 160. The Japanese Ministry of Finance has historically treated 160 as a line in the sand. Past interventions have clustered near this particular level. If the yen weakens towards 160 again, there's a real risk that Bank of Japan hikes rates specifically to defend the currency. And an unexpected rate hike to defend 160 would absolutely destroy short yen positions globally. There's a positive correlation between USD yen weakness and risk appetite in US tech stocks. Trigger number 3, the VAR shock feedback loop. This is a little more technical but also significantly important. Now, when currency volatility spikes, value at risk models that big institutions use, they start to de-risk. This forced de-risking means buying yen to close off short positions. That buying further strengthens the yen, which increases volatility further, and that triggers more VAR-driven de-risking. It's a vicious feedback loop that can cause massive moves in days or even hours. Again, something that we saw in 2024 on that one day. So what should you do amidst all of this? First up, do not panic. If you are a long-term investor with a 7 to 8 year investment horizon, which you anyway should have, right? If you're a stock market investor, remember, short-term volatility is actually your friend. Because when there's volatility, there are chances of buying at lower price, which means more units. Again, in India, domestic SIP inflows have been remarkably strong and have repeatedly absorbed a large part of the FPI selling that's happening right now compared to, say, if this had happened 15 years ago. Secondly, understand that higher volatility is now the new normal. So days when your portfolio jumps up a couple of percent, drops a couple of percent, that is going to be normal, or at least it's going to increase in frequency. The cost of money globally is no longer zero. This means valuations will face far more scrutiny. And thirdly, do not try to time this. Nobody, right? Nobody, not me, not the biggest hedge funds out there, know exactly when or how the yen carry trade will fully unwind. What we do know is that the structural shift is starting to take shape. The yen carry trade has been the primary source of global liquidity for now nearly 3 decades. That engine has started to misfire. That's why stay invested, build a very solid foundation of your portfolio, diversify across assets, and stay patient and prepare for volatility when you invest in the stock market. That's it for today. If you enjoyed watching this one, then check out my video where I talked about where and how you can invest money for your short-term goals, right? Because all of us have those requirements. I'll see you in the next one.